All right, if you own any crypto, you know that feeling, that need to constantly check the charts. But what if you didn't have to? Today, we're going to break down hedging. It's a super important tool for protecting your portfolio so you can worry a lot less about the daily drama and focus on your long-term goals. Let's dive right in. Okay, let's just start with a question that, has probably kept every single crypto holder up at night. You go to bed feeling good, and then you wake up, and it's just a sea of red. What's your move? What's the plan? Because if we're being honest, for most people, there is no plan. You're just along for the ride. If you're just holding your assets in a wallet or on an exchange, your portfolio is totally 100% at the mercy of the market's wild swings.
And that brings us to our first big idea. Smart investors don't just hope for sunny skies, they build a ship that's ready for a storm. They actually plan for that worst-case scenario.
And believe me, in crypto, that storm can hit with zero warning. We're talking about volatility so fast, so brutal, that your portfolio's value could get cut in half before you even have a chance to log in and think about what to do. That is the reality we need a defense for.
So what is that defense? Well, let's try to think about this a different way. This isn't some super complex pro-trader strategy. Think of it as something way simpler. Think of it like an insurance policy for your crypto.
And this is the perfect analogy, right? You have car insurance. You pay a small, totally manageable premium to protect yourself from a huge, catastrophic financial hit. Hedging is the exact same concept. You set up a small position that actually pays you if the market turns against you, protecting your much larger investment.
So, how does this insurance actually work in practice? Well, the idea is surprisingly simple. Just by holding crypto, you're making a bet that its value is going to go up. A hedge is just taking the opposite bet at the exact same time.
Now check this out. This visual really shows how that stability gets created. Let's say the price of your Bitcoin goes up. Awesome. Your holdings gain value. But your hedge, that opposite bet, it loses a similar amount. Now what if the price falls? Your holdings lose value, but your hedge, it gains value, canceling out the loss. You see? The net result is that the dollar value of your position is basically locked in, safe from those crazy price swings.
Okay, so that's the theory. It makes sense. But how do you actually do it? How do you put this into practice? Let's walk through the exact steps to get this insurance policy set up for your own portfolio.
It really just boils down to 3 simple steps. First, you gotta know exactly what you're protecting. So, say you have 20 ETH and it's worth $50,000. That's your exposure. Second, you pick your tool. For this, perpetual futures are kind of the standard because they're super flexible and, crucially, they don't expire. And finally, step 3, you make that opposite bet we talked about. You open a short position for the exact same amount. In our example, for 20 ETH. Now, listen up, because if you only take one single thing away from all of this, let it be this. A hedge must use 1x leverage, 1-to-1. This is non-negotiable. You are creating a safety net, an insurance policy. You are not making a speculative bet. The second you use higher leverage, you turn your insurance into a massive gamble that could wipe you out in an instant.
Of course, no insurance is free, and no strategy is completely flawless. And to be smart investors, we have to be real about the trade-offs. So let's talk about the costs and the very real risks that are involved here.
The main premium you pay for this insurance is something called the funding rate. See, because these futures contracts never expire, there needs to be a mechanism to keep their price tied to the actual live price of the crypto. So, this funding rate is just a small payment that gets exchanged between traders usually every 8 hours to keep everything in sync.
And here's the interesting part for you as a hedger. If the rate is positive, that means most traders are bullish. They're betting the price will go up. Since you're on the other side of that bet, they actually pay you. Pretty cool, right? But if the rate is negative, it means most people are bearish and shorting. In that case, you have to pay the fee. That's the cost of your insurance premium. So, beyond that cost, there is one main risk that can stop your hedge from being perfect. It's called basis risk, and it's the #1 reason your protection might not be 100% effective. So what is the basis? It's really simple. It's just the tiny difference in price between the futures contract and the actual spot price. Usually they move in perfect lockstep. Basis risk is what happens when that small gap suddenly and unexpectedly gets wider.
Let's make this super clear with a quick story. Imagine the market tanks, and your spot Bitcoin position loses $1,000 in value.
Now, in a perfect world, your short hedge would have gained exactly $1,000 to cancel that out.
But let's say because of some weird market panic, the futures price didn't fall quite as much, and your hedge only gained $500. Well, the result is your hedge wasn't perfect. It only covered half your loss, so you still ended up with a $500 net loss. Now, basis risk is usually pretty small, but it's the reason we can never assume our protection will be 100% perfect.
So all of this might have you asking a very logical question. Why go through all this trouble with futures contracts and funding rates? Why not just sell your crypto if you think the price is going to drop?
And this slide right here, this is the big aha moment for any long-term holder. When you sell, you immediately trigger a taxable event. You also take on the massive, almost impossible risk of trying to perfectly time the bottom to buy back in. Plus, you break your long-term holding status for tax benefits. A hedge avoids all of that. You never actually sell your original coins, so you have zero re-entry risk, and you keep your long-term position intact. It's a game changer.
So if this sounds interesting and you want to explore it, how do you get started without taking on a ton of risk? Let's wrap up with some really practical, responsible advice.
The most important thing is to start small and just learn the ropes. Maybe hedge just a tiny fraction of your portfolio at first. Or even better, open a paper trading account and practice without risking any real money. Get a feel for how it works, and really pay attention to those funding rates. And I'm going to say it one last time because it's that important. Always use 1x leverage for a true hedge.
At the end of the day, hedging isn't some magic crystal ball for predicting market tops and bottoms. It's a disciplined strategy for protecting the value you've already worked hard to build. It's all about controlling risk so you can stay in the game for the long haul. So the real question to ask yourself is your future protected?